Hey everybody, thanks so much for joining us today. We have a lot of data to cover this month, so we are going to dive right in. We are going to go ahead and get started with our normal disclaimer. This presentation is for general information only. Basically, we are trusted advisors, so if you have questions about a specific deal and you want to talk to one of our fully licensed loan officers, we're happy to help you. We also have an amazing speaker joining us today that I'll introduce you to shortly, and he is also someone that is happy to help you and talk you through deals. But we want to make sure that you do your own due diligence before going into any deal, and solely that this presentation is for information purposes only. And it's jam-packed with content, so we're pretty excited for this month. I'm going to go ahead and introduce Steve to everybody. Steve Vigil is the president of the Wealth Club and SVSM Enterprises. He and I have a little bit of a joke about that because I am so dyslexic, but Steve is wonderful. I've actually worked with him for a few months in the past when he was taking over the Wealth Club, and so I have to give him high praises. He does an excellent job running the meetings and giving really informative content. They also host classes, but I'll let Wade speak a little bit about it as well.
Yeah, we're very excited to have Steve on the webinar today. He and his team do a great job at the Wealth Club. They provide a lot of great content. They have regular meetings, and one of the things I've always liked whenever I do get to visit those events is the experience level of the people that attend. I think, not only do they have great content and great leadership there, but they also have a lot of great other investors, so you can network with people who are not just thinking about doing deals, but that are very active in the space. And that's another very important part of things. Whenever you join a club, you want to see not only that the leadership is great, but that there are other members that you can network with and that you can become friends with that can add a lot of value to your experience as well. And I'll turn it over to Steve here. We let him talk a little bit about himself and his group.
Okay, well, Wade, thank you very much, and Jeff, both of you, thank you so much for having me on today. I really appreciate it. And hey, that was a great introduction. I really appreciate that as well. But the Wealth Club, we're in our 19th year of existence, and we took over the club 4 years ago. It's hard to believe it's been that long, but we really pride ourselves on really teaching true educational information to everybody. We're not a fluff group at all. We tell it like it is. We teach exactly the things that we do. There's no secrets out there. And so, we always love having everybody join into our meetings, which we have a meeting tonight, which we'll talk about in a second. And I also do a lot of workshops. I'm doing a workshop on the second Wednesday of every month, and so if you get tuned into that, it's always great content. We try to be very relevant of what's going on out there in the market, and want to try and just give you the best education we can. And then, if we have specific deals to talk about, then we can talk about those one-on-one. But at the same time, we are full-time real estate investors. Yes, we do run the Wealth Club, and that takes a lot of effort, but we are out there with our SVSM companies in this industry, so we know what's going on out there. We flip a lot of houses, we own a lot of rental properties, we sell properties owner finance, we do mortgage notes, we do private lending, we do a lot of different things. So we have a lot that we can really tune into to teach, and that also really gives us a great group of people that come and join us on our meetings and become members and get involved with us at the Wealth Club. And just an awesome place to be. So, if you want to get in contact with, well, let me get the contact information in a minute, but my next workshop, let me talk about that for a second. We've got our next workshop coming up on June 9th. We do that at 12 o'clock, just like this. It's a lunch and learn. And talking about being relevant in the market, I've got a guest speaker coming on for this workshop, Catherine Watson, and she's going to be talking about our selling ourselves in the social media world that we've got out there. How do we do that and do it and put our good face out there? No matter what we're doing in real estate or anything out there, people are checking us out. So I think it'd be a good idea for us to get out there and know how to put a good face on these social media platforms that everybody's going to be looking at with us. So get tuned into our workshop. That'd be a great one there. And then we talked a minute about our meeting tonight. We have got a fantastic meeting tonight, and I've got Max Keller is going to be coming on as my guest speaker tonight, and he's going to be talking about you know, not only surviving in this crazy market that we've had and are in right now, but how do we thrive in it? You know, everybody wants to talk about the negatives, but there's so many positives out there, and we always want to focus on the positive. So having Max on tonight, he's going to go into some great information that stuff that we don't really think about, but it's really, really important for us to know and get involved with. So get tuned in tonight. Our meeting is starts at 7 o'clock, and we stream that live. So right now, while we're still doing all the not back in live events, which we're hoping to be doing very soon, you can go to our Facebook page at the Wealth Club Houston, and you can just tune in, and it'll be a great meeting. Have great content. We have a lot of fun. You can ask any question that you want. We'll be there until there's no more questions. So we'd love to get you tuned in for that. So that's just a little bit about us, and you know, I'm excited to get into the meeting here, to the knowledge and the presentation.
Awesome.
So I know you said that it's an online meeting tonight. So when you guys decide to go back to live events, where is your spot? Where's your club?
Well, when we decide to go back to live, actually we're working very hard to right now, but we meet at Quest Trust Company, and in the classroom is where we have our meeting. You know, we have a lot of networking before that. And if anybody that hasn't been over to Quest in a while, you know, the whole lobby has been remodeled. It's just a really, really nice atmosphere. Wonderful building, but we always we're going to serve food. We're going to have wine, beer, water, soft drinks for everybody, and give some great education. We're really hoping that in July that we'll be going back to live meetings. That's what we're pushing for right now. But you know, it's still not confirmed 100% yet, but we're working towards that, and would love to have everybody come out and join us.
Awesome. Thanks, Steve. We look forward to joining as well. If anybody is joining that has heard about us from the Wealth Club, I would like to introduce our two other speakers today, our founder and CEO, Wade Comeaux. And we also have our Director of Lending, Jeff Johnson. Wade started his career in 1995 and has held large titles at huge different mortgage companies. He's a licensed real estate agent. Jiminy Cricket. Sorry, that's my dog. Hey, hush and sit. And he's also an active investor himself. I apologize. I may have to mute until I can get him under control. Be quiet. I'm sure my face turned red. I'm sorry, everybody. Jeff handles all of our lending operations in-house, and he also has over 20 years of experience. He's a wonderful manager, and we love having him on the team. If you've done a deal with us, you've probably worked with both of these individuals. If not, definitely Jeff. And then I'll go ahead and hand this one over to Wade, and I will put myself on mute. I'm really sorry about the dog.
Get the dog under control over there, Destiny.
I'm working on it.
Yeah, so we'll talk very briefly about what we do as a company for those of you that do not know. I think we are a lender that provides both interim financing for purchasing and repairing distressed real estate, as well as permanent financing to hold properties. And we cover a wide variety of those long-term hold products. We're also built by real estate investors. As Steve mentioned, I think that experience and expertise really allows you to make a difference in the investment future, whether you're a mentorship organization like Steve and his team are, or lenders like we are. We're active in deals, we're doing projects, we own rental properties within our organizations, and we try to bring that experience to you to help you be more successful. We've been involved in thousands of transactions over the years. We provide a single point of contact, which I think differentiates us from a lot of the competition. You don't have to worry about working with multiple different loan officers. Our loan officers are all fully licensed, deeply experienced, and can, rather than trying to fit you into a narrow box of products that they offer, they have a broad box of products and can fit you into what's best for you as an individual. We take a lot of pride in our 5-star customer service ratings across all platforms. We average 5-star on Google and Facebook and several other proprietary review processes for organizations that we sponsor. So you can check any of those out and see that 5-star average. As I mentioned earlier, we do cover a wide variety of products, including conventional, which is usually going to be the best price products. We'll talk about that a little bit later. Then we also offer non-conventional products that include 30-year fixed no income doc type programs for landlords to hold properties long-term, very attractive rates at this time. And we'll get into that a little bit more deeply in a few minutes. And we offer primary refinance purchase and cash out loans. If people want to fuel their real estate investment business, a great way to do that is by getting cash out either of your primary residence or of some of your properties that you own. Even if you've only owned properties 5 years, with the appreciation that we've had over the last 5 years, you may have 40, 50% equity in that property now. So it's really been an amazing run for Texas real estate. We offer hard money loans that start as low as 6.99%. And we have a really cool VIP flip program where rates start as low as 9.99%, options with as low as 1 point, and some things that make the process easier for you as a VIP, like easier draw processes, less expensive, things like that. And then we're very excited about some new pricing that we've been able to get on these non-QM and blanket loan products. We're working on a very large blanket loan for an individual at 4% interest rate right now, very low points on that as well. So a lot of exciting opportunities for people in the non-QM stated income space on both blanket loans and individual loans.
Yeah, if I could just add one quick thing, if you're new to investing and maybe you've never done this before, like Wade said earlier, a lot of folks are looking at their, they have some cash, but then they also have been living in their house that's been, accumulating equity for the last 5-10 years at a pretty high clip. And we'll get into the Houston numbers, or any numbers for that matter, but we'll get into the Texas numbers in a little while. Yeah, there's been a lot of appreciation. So a lot of times folks just don't know what their house is worth. So, if you're interested in getting into this business and you are a homeowner, give us a call and we can talk to you about your property. Maybe you'll be able to pull quite a lot of cash out to start buying rental properties. If you think that maybe you're not ready yet, just give us a shout. You never know what you're sitting on.
Absolutely.
Thanks, Jeff. All right, I'm going to go ahead and get started. We're jumping into the data, so hold on to your hats, ladies and gentlemen, because it's going to get busy.
So this chart is a very telling chart. We have people ask us all the time, are we in a bubble? Why are home prices going up so much? It seems like it doesn't make sense. They think back to 2007, 2008, justifiably, like what happened there was a big issue in the real estate market, right? It did cause decreased values in Texas. It may have not been as significant in other areas, but it was very significant across the country. And so this chart tells a lot. What you saw is significant amounts of homes being built, even when their population was far less across the United States. You look here in the 70s at the number of homes that were being built, drastically above where we've been for some time. You look there in the late 70s, early 70s, even in the early 60s, right? Still above the numbers we were building in 2010, even up through 2015. Spikes in the 80s, very high numbers building up until the mortgage meltdown, 2007, 2008. And we have just not been building enough homes across America to really satisfy the demand for homes. And I do not see that changing drastically in the short term, because the home building process, acquiring land, developing it, starting to build, it's a very elongated process that takes some time. And if you look at the number of homes that have been built since 2010, it's definitely far lower than any other 10-year period on this chart, right? It's amazing how many fewer homes have been built over this time frame. So there are some things that could lead to decreasing values, but this is a primary driver in most parts of the economy, or economics in general. It's really a supply and demand issue. And if you look here, this is one of the biggest reasons we have such a shortage of supply. Jeff, Steve, anything to add to that?
Well, I agree 100% with what you're saying. The supply and demand is crazy right now. And, and as we'll get into even the numbers in Texas here in a minute, those numbers are going to show that supply and demand. Unfortunately, everybody wants to come to Texas right now. And the supply is just dwindled down to nothing. And I said, we'll get into that in a minute, but yeah, you are 100% correct. I think supply and demand is playing a huge role right now. And we'll talk about some more reasons that might affect that here in a minute.
Yeah, like you said, we haven't been building at a high enough clip. Then you couple COVID, which I think has made a lot of people realize they can work from home, so they want a bigger space, or they do not want to be living in highly dense areas, so they want to move out and get their own place. Plus, I think millennials are hitting kind of like the peak buying age, right? And they're I think they're the largest group there is. So when you couple all three of those things, it's ripe for what we've been seeing, which is a massive price spike.
Mm-hmm. Well, and I think just to add to that, interest rates.
That too.
Yep.
Yep.
Definitely has increased buying power. You can buy a much more expensive home for a lower payment whenever you have incredible rates.
Yeah. So this chart here says large scale institutional investors are a new entry to the market, but are limited to a select few. So what this does is it shows the market share by owner type, and it breaks out the owner type by the number of properties they own. So if you look to the left, you have, starting at the top, you have institutional investors, people that own a portfolio of 2,000 units plus. You have middle tier, which is 50 to 2,000. You have small investors, which are 11 to 50. And then you have very small, which would be 1 to 10. And I hear a lot of things in the news about large institutional investors jumping into single family, and that is true. But if you look at where we're at right now, it's still an overwhelmingly large percentage of the properties are owned by small investors, right? You have, individuals have a couple rental properties. That is the overwhelming majority of the properties out there. So while institutional investors may be moving in and maybe shifting, those numbers might shift up. It still is a small business, I guess, if you will, that dominates this space for sure.
Yeah.
This next slide, and kind of what we're putting together here are some reasons that our opinion and quite a few people's opinion on where values are going to go from here, right? So this next slide talks about why another reason we feel like there may not be this huge influx of foreclosures at a later date. And it's really because of the equity that has been built into these properties, right? If you look at the numbers, on average, homes with a mortgage gained $26,300 in equity over the last 3 months of 2020 versus a year earlier. So that's just that last 3-month period they're comparing. That average gain is the highest since 2003 when we were coming out of a trough, right? We were coming out of a trough at that time. So it's even easier to have those large gain numbers. And CoreLogic also says that homes with a mortgage account for about 62% of the properties. So the remainder are free and clear properties. And whenever you look at all those properties together, there is an increase of 16.2%, totally 1.5 trillion, in increased equity in those properties. And in the fourth quarter, some 410,000 U.S. properties were underwater on their mortgage. That's a 21% decline from the same period in 2019. So why are we talking about this equity? Why does that make a difference, right? So if someone is in a forbearance at the end of the process, a difference we've talked about a few times on these webinars is that the government has communicated they're going to allow people to add on either in a balloon form or add on to the end of the payments those forbearances. So the previous 2007, 2008, that crisis, the people hadn't paid a mortgage in 12 months. They had to pay 12 payments in 1 month in order to get extended. This is a fundamental difference in how we believe that the forbearances are going to be handled. That's been communicated very consistently. The other thing is that if someone cannot for some reason get a forbearance, because there are still going to be those people who have lost a job and have not been able to get a new job, and you are going to have to be qualified at the end of that period to get the forbearance converted. And if you are unable to do that, you have the possibility of selling the property on the open market. And with so much equity, we believe that there's going to be a lot more gradual and less distressed movement through that because the equity that are in those properties. In the previous time frame, if you remember, there was not a lot of equity in the properties. There are a lot more people doing loans at 125%, 115% of the value. They were doing a lot of stated income loans for which they really could not qualify. And they had a lot less equity in the properties to find a solution if they were unable to get qualified for a loan modification. So because of all that, our anticipation is not as many foreclosures as people might anticipate. You guys have anything to add to that?
Oh, I would definitely agree with what you're saying. I've been saying that for quite some time myself. And I've seen some people I know that did forbearances, that their mortgage companies are coming back and doing a lot of loan modifications with them because they're good borrowers, I'm assuming, has a lot to do with that. And, yes, will we see some foreclosures? Certainly, I think we will, but are we going to see a flood of foreclosures happen at some point? I really don't think we will, and for all the reasons that you just said. At the same time, equity appreciation is going up like crazy right now. The properties that we're selling for over asking price by thousands and thousands of dollars, and our buyers are actually waiving the appraisals. So if the property doesn't appraise, they'll bring the difference in cash to still get the property. So, appreciation is going through the roof, and that will also help, like you're talking about, if you're in a forbearance situation right now, you're hanging on to that property, you're still allowed to hang on to that property. It's going to give you that opportunity, if you've got to sell that property, to actually have something there to break even or make some money and get out of that property.
Yeah, there'll be plenty of opportunities. Somebody who's in foreclosure, there'll be plenty of investors knocking on their door to come buy the property. I don't see that getting to a foreclosure sale unless they just don't respond.
Right.
They'll respond, or they may have negative equity. I mean, there are some people who are still underwater, but 410,000 is a far lower number than people with negative equity in 2007, 2008. That number was exponentially higher than that.
Yeah. 2007, 2008 was terrible. Yeah.
I got to believe that those negative equity people cannot be in Texas. They've got to be elsewhere.
Well, places where they did those 125% loans, maybe, a while back or something like that. Okay. Jeff, why don't you cover this here, the Fannie Mae change?
Yeah. So, I'm not sure if you guys are aware, but Fannie Mae did make a rule change. There was really no warning. It just came out and made a change. But it said 7% of acquisition of single-family mortgage loans secured by second homes or investment properties. The previous limit was 17. So what that means is mortgage companies can only sell to Fannie or Freddie. If they sold 100 loans, only 7 of them could be for investment properties or second homes, as opposed to the previous rules where they could sell 17 out of 100. So, and there was no warning, there was no heads up, no grace. It was, this is happening right away as of April 1st, and that's that. So, because of that, it's put some pressure on conventional pricing, because certain lenders are over that 7%. They're well over that 7%, and that was fine until a few months ago. So, that is happening right now. So there is some little pricing pressure for non-owner occupied conventional pricing. So the question is, what's going to happen next? Is the government are they going to ease back? Is some private money going to step into the space to kind of fill that gap? Because the loans are still good. It's not a performance thing. I think it was more of a policy thing where the current administration wanted to encourage homeownership more so than investment, I guess. But it is a little bit of a challenge, but I do think private money is going to step in and has started to a little bit already. But that is happening. That is something. I don't know, Steve, if you're aware of that or experienced any of that.
No, I wasn't aware of that, but I mean, all we have always done since we've been in businesses is I've always done private money. And I mean, I do have some institutionalized money on some refis for rental properties, but I have a lot of my rental properties are done with private money. So I try not to play in that playground over there, because it makes life so much easier for me. and I don't have to follow all those rules. But for most Americans, for most investors, like you talked on a slide or two back, looking at the small investor that owns, I think the national average is 1 to 3 rental properties is across the board, and so those are the investors that are going to be getting those more traditional type loans like that this will certainly affect. Yes.
I do want to make a couple points, and I apologize for not catching this up front, but this is not just a Fannie Mae change. This is a Fannie and a Freddie change. So this is through both of the government-sponsored entities. And there has been some pricing pressure, but we're already starting to see some relief there. There's starting to be some normalization. And we are supposed to have direction from Fannie and Freddie, I think, early June on where we go from here. So we're all anxiously awaiting that. But to Jeff's point, we're going to talk about this a little bit later on, and I alluded to this fact earlier in the presentation that there has been an aggressive move by Wall Street money into the non-QM, non-qualified mortgage space to provide no doc pricing, which is very competitive and not that far away from what we're seeing on a lot of Fannie Freddie deals at the moment. So, and we do anticipate over time that there's probably going to be some full doc products that may even be better priced that come in from that private area of the lending space, Wall Street type money, securitized money, that could provide a real consistent competitor in the space, because these loans perform very well. As Jeff mentioned earlier, the non-owner space has actually outperformed the owner-occupied space in both delinquency and, of course, in profit, because those are priced a little bit higher because the perceived greater risk because it's not a primary residence. All right, so on this slide, we're just looking at historic interest rates. We cover that quite a bit. There, we periodically hear from people who are frustrated with the rates during this time because it has been a transition from where we were just a few months back. It's a little bit higher, but still historically incredibly low in comparison to where investors had to invest their money in the past, right? If you were going to buy a rental and the interest rates were 18%, probably a tough time to cash flow back then, if I had to guess. Easier to cash flow at our current rates for sure, but just to keep, for people who do not look at these type of charts, give a little bit of historical context. Even if rates go up 3%, which I do not anticipate in short fashion, we're still well below where rates were for an incredibly long period of time. And real estate investors were still in the space, making money, owning single family rentals. So in our opinion, and even if things change a little bit and go up quite a bit, it's still an incredible time to invest in real estate because of pricing.
Yep, very true.
So, so this is the Houston data. I will cover some of it. I'm not gonna read all of it, but there's some good stuff. And Steve, Wade, obviously feel free to hop in because this is our area. Single family homes increased for the 11th month in a row. Days on market dropped all the way down to 40 days on market. Single family homes months of inventory was a historic low of 1.4. Interesting, below the national average of 2.1, which is, I don't think that's normal for Texas historically. On a year-to-date basis, single-family home sales are running 24% ahead of 2020. Now, that's, I'm sure, there's a couple early 2020 were some COVID months, so that seems that's probably a little outsized than what would happen normally. But 24 is a pretty big lead, and it's already that's April, so
yeah,
4 months in, I got a 24% head start. And then single family home rentals, the actual units fell 3%, but the actual rent went up 11% to almost $2,000 a month. If you look on the chart to the right, the numbers are just obnoxious. April units 58%. The total volume, which is basically units time the prices, is up 86%. It is almost doubled in a year's time. The active listings are way down, and we've been talking about that for a while now. But if you look at the single family pending sales, again, in April of 2020, you had 6,400 pending sales out of 39,000 listings. Now you have 11,000 pending sales over 22,000. So it's almost half, right? That is, if you just compare the numbers, the percentage, and it's not the exact same deals, but if you compare the percentage of pending sales to active listings, like you cannot keep a house listed. If your house is on the market for too long, it's because it's priced too high. Single family average, and I'll just hit those two record highs. The single family average sales price is $371, and then the median is $295. Those are up 20 and 18% respectively. Again, really, really high numbers for the Houston market.
Yeah, real strong numbers.
Yeah. So this next slide is interesting. And this has been a trend for the better part of the last year and definitely the last year. And what we've seen is that the higher priced homes, more expensive homes, are moving very quickly. And then the price point is just, the number of transactions happening in those price points has just really, really grown. And a lot of real estate investors, Steve, I will ask you in a second what you have taught over time of good areas in which to flip properties. But the number of people that flip in that 750,000 and above range, there's not that many that do it. They're highly skilled. It requires a certain type of product for sure, very high quality, but it's always been an area where there is more risk because those homes do not move as quickly in the past. And we're seeing a change there. Those homes are moving very quickly. A lot of people perceive it's that people moving from more expensive priced areas like California or New York are moving into the area, and those homes, they're selling homes that are very expensive. They're used to paying more for homes, and that could have a big part of it, but they are moving quickly and the prices are growing very fast, even in those higher areas. So we're starting to see more investors be confident flipping in that space. I do think over time it may still be an area that's going to be impacted first before the lower price points. I think that's always where you see the price reduction, or at least a slowdown, happen first. But it's been an incredible run on the higher priced homes for quite a while.
Yeah, I would totally agree. I'm actually, kind of surprised at how that's gone, because I've, for quite some time, I've always talked about how I stay out of that playground, because if things go bad, that's where it's going to get hit first. For as far as rental properties, I'm an affordable house guy, so I stay in those lower price points. On the rental properties, I love my ARVs on rental properties of 120, 130, 140, or even 100. But when it comes to flipping houses, for probably the past 5 years, I've stayed in that 250 and lower market. And I will say from that standpoint, those houses that price point's moving very quickly if you've got them to sell. Even in the 350 and 400 range, they're moving very quickly. But to see the increase in the 750 and above is not something that I would have expected. But that just goes to show just how crazy things are out there right now.
That's the wild, wild west. I popped back on just because I'm so excited for these next graphs. This is new info we don't normally cover. But I was blown away. I put them all over my Instagram and everyone was confused because not everyone on my Instagram is in real estate or investing. But Wade, I'll let you cover these. These are very exciting. If you guys aren't looking at the screen, I would recommend taking a peek at these.
Yeah, so we're covering residential sales volume. And you can see the previous several years where the trends were. They were relatively close in comparison, going January through April. And you just see the end of last year, how significantly higher it was than the rest of the trend lines in the 3 previous years. And then starting off in 2021, a great trend line as well. So just a lot of volume taking place in the overall sales. Now, admittedly, it's down a bit from the end of last year. There's no doubt about that. But this is a slower time of year as well in the first few months. Every season there's a slowdown in the January, February timeframe. But overall, this trend line is consistently above where we've been in the past.
Yeah, if you look at that, like I see that chart and I say, okay, the beginning of 2020 was, I guess everything was normal until March and things got completely jacked. and you hear that dip when everyone else, every other year is going up, and then there's that dip. But it seems that like things kind of normalized around August, and it followed the same chart from there on out as the rest of the years, but just the difference is how much higher it is. So I think things are back to normal as far as the ebb and flow of volume month to month and when people buy and when people don't. It's just a lot higher than it used to be.
Mhm.
You would anticipate a big summer with how the trend line is going.
Yeah, I think so.
Yeah.
So this chart is the median sales price, and this is where the difference really jumps off the chart. Destiny seems super excited with this chart because it is kind of cool. If you look at all the others, there's this steady and slow increase, 2017, 2018, 2019, 2020, and then boom, like it's just almost off the chart with where we are in our 2021 trend. Despite having lower sales volume, some of that seasonality, some of that just the fact that there is not a ton of inventory, but the pricing really jumped through the roof.
Mhm.
This looks to be the inverse of what we were talking about, just the months of inventory, where everything's hovering around that 3 to 3.5. And then right around right around, I guess, June of 2020, it just takes a nosedive and it stayed there. There's just not a lot of houses for all the reasons we talked about in the past in the first slide, with the lack of building, more buyers, I think more of a rush to people wanting to buy houses. This is an obnoxious chart for sure.
Yeah, that's why Steve said he's been so busy if he's got those homes in that lower price point to sell. It's just everybody wants it.
The inventory is crazy. We list a property, from day one, we have 15, 20 showings. Day 2 or 3, we're getting anywhere from 6 to 10 offers, all over asking price. I mean, it's insane. If you've got properties to sell right now, get out there and sell them. You will come out really nice.
And from an advice standpoint, Jeff mentioned this earlier. If you have not sold your home, if you've not had multiple acceptable offers in the first week at minimum, then you are priced outside the market, and the market is telling you that, because we just do not see that happen. We've listed a few properties in the not too distant past, and same experience for us. Let the market speak to you. If you're not getting those offers, then you need to adjust your price and get in line with the market, because you should be selling them very quickly.
Yeah, well, and if you price it correctly to start off with, then chances are that price is going to get driven up because of the demand.
The multiple offer situation, yeah. I mean, that's incredibly common right now.
Yes.
All right, and we're hopping into San Antonio.
Sure, I'll do San Antonio. So it may be kind of difficult to see, but if you focus on the yellow there, it charts the single family as the top chart, the year over year number of sales. There's 27% more sales. The average price, again, a year ago was $273. Now it's $333. So again, very similar to Houston, with massive price increases and volume increases. The median price kind of follows. It's a little bit lower than the average, but it's up 15% to 277. Days on market, if you look down, it is 36 average days on market. A year ago was 61. That is a massive, I think that's more of a drop than Houston had. That is a massive drop, 41%. As far as the rentals go, there are fewer rentals. I'm sorry, there's more rentals, 8%, and the price has gone up as well. It's not as high as Houston. Houston averages around, I think it was like 1950, almost 2000, and San Antonio is in the high 15s, but still a very healthy rental market for sure. I think Houston and San Antonio are probably the best opportunities as far as cash flow deals in the state. And Austin and Dallas are getting priced out. They're just too expensive. I mean, they're still good deals, don't get me wrong, but as far as if I had to pick a top 2, Houston and San Antonio would definitely be it.
Yep. We have a lot of Austin and Dallas investors buying in both San Antonio and Houston, because there's a lot more total deals, but then there's also a lot more deals with significantly greater cash flow just with the price point, which we'll get into that affordability
Do you
index.
guys do any? Do you guys do anything outside of Houston, Steve, or are you all Houston?
Well, we're the greater Houston area. I mean, we hit all the counties around Houston, but there's so much here that I haven't felt the need to go anywhere else. I have people ask me all the time if I go out of state, and I'm like, there's no need. And I really like the real estate laws in Texas too. So we say you know all the counties around Harris County. Actually, we're working all the counties around Harris County except Harris County right now.
All right, so Dallas, real estate still trending very well, obviously. If you look at the price point, up 17.3% year over year. Active listings down 52%. Months of inventory, shade below Houston, actually at 1.3. Number of sales up 36% year over year. And then the days on market is still a very attractive number, 18 days less than April 2020. So a very hot market in Dallas as well.
Mm-hmm.
And we've got some additional information on Dallas this month. I know we normally only do one slide, but we have that same information showcasing the sales volume, median home price, and months of inventory. So I'll let you guys take it over and talk on it, but I just love these graphs. I wish we had them every month.
Yeah, we'll kind of go quickly through these in the effort of time because we have some good content in the end and we do want to be available for questions, but very similar to the Houston charts. If you look at them, sales volume up significantly, that same trend, very comparable trend to Houston, actually. I would say that the sales prices may have been even a bigger jump relative over Houston. I mean, you can see it's a very tight market there.
Yeah.
And then days on market, as we said earlier, a little bit lower than the Houston days on market, but just a relatively consistent trend line for the previous 3 years, and then just a total lack of inventory in that second half of 2020 and year to date.
Yeah, I do think I noticed a little difference. Houston was always in the 3 to 3.5 range on the previous years. Dallas is closer to 2.5. So they kind of had a head start on Houston before this happened, and they kept it. But it was a little tighter market in Dallas to begin with.
Right. Mm-hmm.
All right, are we keeping Austin weird? Jeff, would you like to take this one?
Sure. So Austin is I guess however you want to look at it, the rock star of Texas as far as the prices go. The median sales price was $460. That's up over 40% year over year. Closed sales 3,600. That's over 37%. Average days on market are down to 17. New listings, I thought that was an up 4,600, up 33%. I guess that's maybe a COVID thing because maybe last year, April, that's maybe why they were down. It seems like a high number. Active listings down 70%. So that just tells me that if you put a house for sale in Austin, it's going like right away. It'll be sold. Pending sales 3,900, up 50%. The total dollar volume, if you remember, Houston was, I think, in the mid 80s as far as the percentage increase. Austin is almost at 100. They're at 96%. $2 billion of real estate was sold last month.
Wow, that's crazy.
Yeah, and the months of inventory is down to half. So just for I know we haven't talked about it yet, but for reference point, a market in balance is 6 months.
Yeah, their inventory is insane. I mean, that's just crazy.
Yeah. So just so you guys, if you don't already know, what that means is that if no other properties were to hit the market, every house in Austin would sell in 2 weeks. There'd be no houses left for sale. They'd be gone in 2 weeks. That's crazy.
That is crazy.
That's very, very insane to see that. That number just blows me away.
And there's a lot of factors there. There have been a lot of very large tech companies that have moved into the greater Austin area. I'm sure you guys are probably familiar with some of the names, but like Tesla has some operations, some other major companies have moved there. So increasing not only jobs, but higher wage jobs, that I think is driving a lot of these higher prices, right?
Yep, I would agree.
So again, holy cow, same chart, same concept, right? A lot of the same stuff you saw for Dallas and for Houston. That's a pretty steep line you got there.
Jan Feb were down.
What's that?
The total volume in January and February were down from the end of last year and then this year.
Yeah. Yep. Sales price, same. You know, every last 4 years, they kind of hovered relatively close between, I guess, like 275 and 305. That's a pretty tight range. And all of a sudden, they started out in the 360 range this year.
That's a crazy trend line.
Yeah.
Then they had to create a new chart for us, and they probably didn't even have a half down there. Right? Everything was between 1.5 and 3.
I've been doing this, full time for about 8-9 years, and inventory's been between, at the low, about 2.8 to maybe 4.1, and I think everybody got pretty used to that, which was still way below. And now what we're seeing with this going down to, in Houston 1.4, Dallas 1.3, Austin a half a point. I mean, it's just insane.
Yeah.
So this right here, I know we want to probably leave some time for questions. I don't know if you have questions, Destiny, but we always want to try to leave a little time. So
Jeff,
this is.
Sorry, you cut out just a little bit there.
Can you guys hear me? Wade, Steve?
Yeah,
I can hear you now.
Is this better? I'll talk louder. So this is the Texas A&M report. They do a really good job. They put out data every month, and it's very robust. This first bullet is more of a, I guess, a subjective statement, but these guys know what they're doing. So the unprecedented low level of inventory available for sale is the greatest challenge to Texas housing market. Like we talked about, there's just not enough inventory to go around. And there's another chart we'll talk about in a minute. The home builders are trying to play catch up, but they're not quite there yet. Texas months of inventory is down to an all-time low of 1.4. And Steve, this kind of points to what you were saying earlier. Homes below 300,000 were all the way down to a month. And Houston below 300,000 was down to 0.9. So to your point earlier, the lower price points, if you have a house for sale that is a little bit lower in the price point, it will go very fast.
Yeah, fly off the shelf.
Texas median home price was up 14% year over year to 283. So that's statewide. And then the affordability rankings came out. And basically what this is it's a comparison of the average income in a certain city relative to the mortgage payment, which is determined by the prices and maybe taxes. And the higher the number, the more affordable it is. So if you look at Fort Worth and Houston, very similar, and San Antonio, all very close, 1.8 to 1.78. And then you can see Dallas dips down below as well to 1.66, and then Austin down to 1.57. So I don't know if you guys are familiar with these charts. Steve, if you look at this kind of stuff, I know you said you like
seen this chart before. No. Yeah, that's.
Yeah, and to give some context, I think the next slide is a very powerful slide because it gives a comparison.
Yeah.
We could go to that. So if you look at this chart, it basically gives a slightly different metric for affordability. Basically, it's saying the percentage of someone's income that has to go towards housing, right? So someone in Los Angeles that makes $62,000 a year, whenever you have a mortgage payment built on the current interest rates, which are absurdly low, right? We all know they're absurdly low. 84% of the money that they make has to go towards their mortgage payment on average. keep in mind also, if someone makes $62,000 a year in Los Angeles, they pay, from what I can tell, an extra 9.3% state income tax over what people in Texas pay. So you take another maybe 6,000 off the top there, and you can see why it's very tough to live in Los Angeles and several other cities. And there's such an influx into the state because of having more affordable homes and also not having that additional state income tax. So whenever you go down this chart, you look at, you know, Dallas and Houston are in that top, depending on the way they measure the city size, you know, somewhere in the top 10 for sure, often in the top 6 or 7 largest cities of the United States. So you're comparing to the Los Angeles's, Miami's, New York's, San Francisco's of the world, and you can see how much more affordable the homes are for comparably sized cities with the amenities that many of these Texas cities have, the options that we have for entertainment and other things like that. So very powerful. Oh, somebody is progressing through the slides there. Is that right?
Sorry, I was trying to point where the just at where the 62 was, and then we have another one right here, and then I pressed a button.
Well, we do have a lot of the Texas cities there. We just try to provide a little bit more of a holistic view, but you can see the affordability index, and there's a lot of people that are starting to invest in these tertiary or secondary markets. I know Steve, and I'm in agreement with him. The rentals that I own are here in the greater Houston area, but you can see, you know, these are solid cities with good job markets, and they are, you know, they're the average income in San Antonio, Corpus Christi, it's actually higher than Houston, believe it or not, but their home affordability is pretty powerful. So I think that there are some tertiary markets that are attractive.
Oh, no, yeah, the affordability of properties all over Texas is phenomenal. That's always been a great attractor to Texas and I mean, Houston, Dallas. I mean, I think it's a big driver, along with the fact that these are all large cities that have lots of jobs to offer, and that's where people are going to go. And if we're going to invest in these markets, these are very good markets to invest in, and values are going to continue to go up as we invest in these markets.
I like this. You know, for all of the things we've been saying about how ridiculous things are, and prices keep going up, and you know, the real estate market's great. This gives you some context as to the rest of the country, as to why, you know, certain markets in Texas and Texas in general is still a really good place to be if you're looking to buy properties and cash flow. You know, try cash flowing in Seattle, you know, or Miami. It's just,
well, you're not going to cash flow in San Francisco.
No.
Another thing we're not even baking in here, if you think about it, when you look at the affordability, is the amount of the down payment someone has to make, right? Because
the amount, the down payments. I mean, that it's just crazy amounts of money, and I mean that's why, you know, that's why I'm here in Texas, in the Houston area, and that's why I'm going to stay here.
No doubt, yeah. To come up with, you know, if you're doing 20% down on 950,000 or 1.3 million, that's a sporty number.
Mm-hmm, yeah. Well, and it goes back to what I said earlier about, you know, when people ask me about going outside of Texas, why would I want to?
Yeah, proximity definitely makes it so much easier. There are some other markets out there that are, you know, like Atlanta, that's a major city, pretty attractive. Yeah. There are some other markets that seem relatively attractive, although we do hear from another networking organization we work with that has a big group out in Phoenix that they still come into Texas for a lot of their investments, even though here it looks like.
Yeah, I was just about to say Phoenix was good. I guess not, huh?
Well, I mean, you know, it is, you know, it's more money. It does look like they have more income. So I'm not sure exactly why that is the case, but they seem to look here. Maybe I think as one thing that Houston has that isn't really baked into this 310 number, and I think Dallas, certainly San Antonio is similar. I mean, if you looked at, instead of the, I'm assuming that this is a median, no, this is an average home price. There are a lot more homes on that low end, like Steve was talking, $120,000, $150,000 homes. I think some of these other areas do not have as many of those.
That would make sense.
That could, that could be. That definitely could be. And you know, if you drive around the Houston area, you know, or just Harris County, I mean, there are hundreds and hundreds of neighborhoods that fall into that category of an ARV of 120 to 150. I mean, there's thousands of them.
All right.
So I'll cover this chart briefly. It kind of touches on what I was talking about earlier with the construction. This is, those are three things. Those three numbers represent the three colors. What's the construction that's happening in Texas is the blue. Construction that's happening in the United States is the red. And then construction that is going to happen in Texas is the green. And so if you look at it, it says they call it the leading index for Texas is at an all-time high. So they're trying to play catch up, like between permits and housing starts. There's a lot of construction going on, and there's going to be more going on in the future. So this might start alleviating some of the pressure we see as far as the pricing, once they start building houses. But there is, if you notice, also typically, and especially from 2000 to maybe 2006, the U.S. was a little bit higher than Texas for a little bit of that, but Texas has been blowing the rest of the country out of the water as far as new builds.
Mm-hmm.
So let's see, I'm sorry, I'm on the wrong slide here. So the construction permits have been an interesting thing that we've seen, for up until 2006, these were kind of moving in parallel, even dropped in parallel, coming up relatively in parallel, but we have seen a widening gap in the new construction permits for single family. And there's a lot of different reasons why. Texas does have a reasonable amount of land, but I think arguably the biggest thing is just more reasonable allowances to build new properties. And Austin is arguably the city in Texas that has the most restrictions, and their prices are growing more rapidly, but Dallas and Houston and San Antonio do not have some of those same restrictions, and it's a supply and demand model there too. So it's a lot easier to build new homes in Texas, keep the prices down because of those restrictions in comparison to some of these other groups that were on that affordability chart where prices are going up exponentially. They really cannot build as many houses. It's a longer permitting process, more green space requirements, et cetera, that make it a little bit tough.
Yeah, I think we're almost out of time, and we have some questions lined up, so I'll try to go through this pretty quickly. This is the Texas current months of inventory by price, and I wonder why 200 to 300 is lower than the 0 to 200, but all of these numbers are really, really low. But as you can tell, as price points go up, it takes a little bit longer to sell, but honestly, not much. The fact they're at 500K and it's at 2.4 months of inventory, that's very telling, especially for Texas.
Mm-hmm.
That chart a year ago and every year before that was much bigger gap between the lower priced homes and the higher priced homes.
Yep.
So this chart is the home ownership rate. You can see it was really trending up pretty significantly, and then it has dropped right now. A lot of different theories as to why that might be, but there is some new inventory, and candidly, a lot of landlords are buying up the properties, institutional and individuals. So there's this home ownership rate is a percentage of owner occupants, but it is dropping pretty significantly. You look at that 67 down to 65 in relative short fashion lately. So that is a big drop. There's also some word that there may be the mortgage interest deduction going away. So some people are thinking that reason to be a homeowner rather than a buyer, if it goes away, that really changes the dynamics of where people say it's a better decision for me to own instead of rent, because then I have to make the repairs, I have to do all these other things. It's I'm not as easily able to move around. The first 5-6 years you own a mortgage, oftentimes you're upside down until you get to a point where you pay it down enough to make sense over renting. So I think that is probably going to be an ongoing thing, especially if that mortgage interest deduction goes away.
Well, do you think also maybe the fact that because of so many of our institutionalized lenders have changed their rules, that such a much larger percentage of people have fallen out of qualifying for these loans because of the rule changes and, higher credit scores and things like that. Does that maybe have an effect on that as well?
Jeff, you can correct me if I'm wrong or if you're aware of anything. I'm not aware of anything that has happened since this time in 2020. There was a great tightening after, 2008, the mortgage crisis, and the credit quality of people today is significantly higher than before that crisis. But we did have some people did have some overlays on the non-owner occupied side, but I'm not aware of any. There were some momentary blips where they kind of said we were a little bit more careful, but I don't know that it was massive.
Mm-hmm. Okay.
I don't know. I mean, I'm just purely speculating. To your point, a lot of folks there's a lot of institutional guys buying properties. I don't know if this chart is right around, COVID. I don't know if, I know a lot of people lost their job, right? There was that. And I know there were some tightening restrictions in the very early months of COVID as far as employment. Like they were a lot more difficult on verifying employment. That might be why 2 points is, it looks like a lot on this chart, but it's only 2 points. So maybe that's it,
To Steve's point, I'd forgotten about that. It was like the requirements to verify employment twice right before the loan closed.
Right.
Were very restrictive, and a lot of people were either on a furlough and they've gone back, or they were actually laid off. So that is a very good point, Steve. It's been a while since that happened.
Well, you're right. Yeah. But just kind of looking at where that falls in 2020, that may, of course, it'd be, I'd like to see this chart go farther out, where to see how that recovery or how that graph changes.
Agreed. Tell the Aggies to hurry up.
Yeah, right.
So guys, thank you so much for being on our webinar today. We do have a few questions, but we want to be respectful of your time. If you can't wait that out, no worries. You will get a recording of this webinar. We're going to send it to your email, and you'll also receive any additional links that we'll provide you, because we do send you a few different things with that. I also want to invite you to take a look at Steve's organization, the Wealth Club, and thanks, Steve, for joining us today.
Thank you.
Again, he is having a Facebook meeting tonight, so check out their Facebook, join them live, and he has a great guest speaker tonight as well. You said Max, is that right?
Max Keller, yes.
Max Keller, okay, great. And as always, if you haven't already, make sure you follow us on social media so that you can hear about our upcoming webinars and events. We are getting so active as the summer comes around. It is very exciting, especially being a marketing person. Back out in front of people is something I really look forward to. So hopefully we'll see you guys at some of these events that are coming up. But without further ado, we'll go ahead and answer some of the questions. I put them all in one spot, so we are lucky today. So this one's great. I'm really excited to hear your answer. Nobody was specified, so whoever wants it. Do you think there has been a significant urban to suburban migration trend?
Yes.
I'll say yes.
Apartments are not being built. We did not cover that chart this month, but that is a downward trend as far as new starts. They're still being built, but not at the intensity that single family is being built. And there are a tremendous amount of people that move from the urban areas into the suburban areas for a wide variety of reasons, probably the biggest being larger yards, the ability to have your own amenities, not needing to go somewhere else to swim in a pool, or that extra room to have a work from home office or potentially a home gym. So I think a lot of people wanted to have, in general, just more space, and that's more affordable and available in the burbs.
Yeah, I would agree. I mean, I think a lot of people, I mean, you have your inner city folks that want to live, in those areas, but with everything as we've kind of gone through this past year, and people, wanting to, staying at home, working from home a lot more, getting into larger places, getting out away from people, I think we see a lot more people coming out to the suburbs.
All right, thank you guys. My next question is, where do you believe conventional interest rates are going? So
I do believe that there's going to be some relief once there's clarity on where Fannie Freddie is going to go on the restrictions. Is it going to stay at 7%? Is it going to tighten further? What are the penalties going to be for people that are above those numbers? I think sometimes fear of the unknown is greater than reality. So I think everybody is kind of being very cautious. Most people in the lending space are being cautious to see where that direction is, but that direction should be forthcoming. So I think that will normalize some things. I'm very excited about that possibility. But if the numbers are lower, then there's going to be fewer people that can get qualified. So those people are going to move into different spaces, like we talked about non-QM, some other things like that, which is a non-qualified mortgage. The rates are tighter than they've ever been right now. So that's a very attractive area, and it's an easier product for people. So that's a good alternative. But I do think there's going to be some relief in the short run. But the other thing to keep in mind, if you look at historical charts where you lay inflation and interest rates, the way that inflation is controlled is by one of the primary levers is by increasing interest rates. The cost of goods has gone up, like copper, lumber, all these things are up sometimes 100% year over year, 80%, really big numbers. So if there is significant inflation, while the lever that the Fed uses to change that interest rate is not a direct correlation to mortgage rates, it definitely impacts it. Maybe not directly, but it does impact it. So my anticipation over time is that rates are going to go up and that it is a very good time to take advantage of them while they are so low. Steve, anything to add to that?
Well, I mean, I think at some point, we'll see rates go up. Yes. I mean, because the balance is, it's going to happen. When that's going to be, who knows? I mean, you have a really good insight to that, and your explanation I thought was fantastic. But right now, take advantage. In real estate, we're always going to have windows. And we're in a window right now that, we need to figure out what we can do to take advantage of that window and make it work to our advantage, and just take every step forward to put yourself in those positions and move quickly. And when it changes, we have to shift again and go with what the changes are.
Yeah.
Thanks, guys. This next question is a three-parter. It's a little long, so maybe we'll all jump in on it. As a new investor, what are important things I need to pay attention to in reference to financing when I want to hold rentals? That's the first part. Most important, this industry is a lot to learn. What market is the best to invest in and why?
Can we take them one at a time? So
Okay.
Yeah.
My memory's not that good. Let's just go with one.
This question again?
I feel like we're on a TV show and we just lost points, for the buzzer. We can get it in. I'll read the first part of it. As a new investor, what are important things I need to pay attention to in reference to financing when wanting to hold rentals? So I think they're asking just for basically like what's really important to consider when financing if my long-term goal is to hold rentals.
Well, I'll start that off. I think first off, you need to go out and you need to get qualified and find out what rules different people have. Everybody has different rules of how they do things, and then you have to find what fits into your box. But getting pre-qualified, knowing where you stand, and talking to Catalyst Funding to find out how the game works, educate yourself by asking the experts, and that's going to help guide you in the right direction for yourself.
Yeah, I think it's most important to understand that general responses to this question do not necessarily solve your individualized challenges. You may be self-employed, you may write off a lot, you may have a W-2 but not make that much money, you may have had a decrease in income in the last year. The good news is there's a product for you if you want to invest in real estate. That is the good news. As long as you have a little bit of cash, there's going to be a product for you. So I think if you work with a group that's well-rounded, which I'm proud to say that we're pretty well-rounded and that we can find a product that's going to work for you. I think the most important thing, to Steve's point, is talk with somebody who's reputable, have that conversation, submit an application, and then find out the path.
Awesome, thanks guys. The second part of this question is what market is best to invest in and why?
Well, there again, when we talk about best market for rental properties, it's going to depend on where you are. For me, I'm affordable housing guy. I like the lower income properties because I make much higher rent ratios with the lower price points. I've always tried to position myself to be as recession proof as possible. So if I have the higher price rental properties and we have a big, layoffs across the country and people are losing their jobs and have to move out of those more expensive rental properties, they're going to be moving down to my price point of rental properties that they can afford. So that's how I look at it personally. Not most people don't do rental properties the way I do. Obviously, I've got more issues to deal with at times because of that, but we're very versed in doing that. So you have to look at where you're comfortable at what price point. Like I said, I know people that would not go into neighborhoods where I have a lot of rental properties, but I'm very comfortable doing that. So kind of figure out what price point you feel comfortable in, and then start educating yourself on that.
Yeah, I'd agree with Steve in many ways. I think there's a lot of things to consider. One is proximity and how involved you're going to be. Like if you're going to be the one managing the project, you're going to be the one managing your own rentals, then there are some real advantages to having them in the same city or surrounding area. If you're going to use, mentors and or agents or a property management company, that is not as important. And a lot of people are very successful because if you want to invest in single family real estate in San Francisco or Los Angeles, as you've seen from the charts, probably not viable. So you do have to go outside of your area. And I think if you have the right team, you can do it out of town pretty well. But looking at that chart, I think two of the areas that most people kind of intuitively thought were great areas are San Antonio and Houston. So if you happen to live in Houston or you happen to live in San Antonio, you're blessed because you don't have to go far to find great deals. And if you go into the 2 to 4 units, and sometimes you find a gym in both Austin and Dallas, you can find some deals as well. But another thing that spoke to me on that chart was those tertiary markets and how income levels are comparable to Houston and other areas, but the homes are a lot cheaper. So I have a feeling that that's going to become more and more popular over time, as long as you have a team that can help make sure rehab goes right and you can manage the properties.
All right, guys, we have one last question. Thanks anybody and everybody that hung on for these extra 10, 15 minutes. So this is our last question. This might be a Jeff question. What's the average cost to get an investment property today?
The average cost. It's funny you say that because I literally was just working on a project that had that exact question. So if you're looking for rentals, typically like the average loan size, the average purchase price is going to be around the 100 to 120 range. And then you're looking at, if you're doing a rehab, the average rehab is probably in the 30 to 50 range. I think as far if that answers the question, yeah, the most of the average price is in the low hundreds with rehab though. Now, there's obviously anomalies. Sometimes there's much higher prices depending on the size of the rehab or the after repair value, what you're looking for. Sometimes they're way cheaper, but you have a lot more rehab ahead of you. So it's a balance. Typically what I look at is, if you're an investor, you'll want to look at as what is the percentage of the ARV you're going to pay. If you think the house is going to be worth $200,000, when you combine your purchase price and your rehab budget, right now we're seeing mid to high 80s a lot of times for those types of deals. And obviously there's a sliding scale based on your cash flow. The more cash flow you have, maybe the more likely you're to pay, right? Maybe you can go a lot higher on your prices. If you have a little cash flow, then you better be getting some appreciation. But to answer the question, I would say the average purchase price is somewhere in the low hundreds.
Awesome, thanks, Jeff.
Never mind.
So before we go, is there anything else that we'd want to share with our audience? And again, Steve, thank you so much for joining us.
Well, thank you for having me. I really appreciate it.
Yeah, thanks a lot for joining, Steve.
Yeah. Thank you guys for having me, Jeff, Wade. I really appreciate it. I think if there's any little advice to leave anybody that's out there is right now it's time to get involved, take action, go out there and get the right education for whatever type of investing you want to do. And once you get that education, you got to pull the trigger. You got to go make it happen. There's some great opportunities out there. There's going to always be opportunities. That's not going to stop. We just have to go out and make it happen.
Awesome. All right, guys. Well, thank you everyone for joining us again, and you will get a copy of the webinar. Have a great day.
All right, thanks, Steve.
Okay, thank you. Bye, everybody.